Heading into the Monday open, the market is caught between two massive, colliding institutional forces taking exact opposite sides of the trade. On one side, foreign institutional investors, or FIIs, are demonstrating structural bullishness across their entire portfolio. They are aggressively accumulating long positions and backing them up with heavy capital additions in stock futures. But staring directly across the order book are the proprietary trading desks, or pros. These institutional desks are executing a contrarian strategy, hoarding an anomalous 3.15 lakh index put contracts. Retail traders relying solely on price action are stepping into a gap between two institutional giants moving in opposite directions. We can identify the stronger force by cross-referencing these participants with the specific strike prices where they are underwriting risk on the option chain. The data reveals a specific map of institutional battle lines drawn across the Monday open. This open interest matrix filters out the noise to isolate upside exposure through index calls and stock futures. In the retail column, traders liquidated calls, reducing net long exposure to just 39,000 lots. Retail has abandoned the upside, leaving them unpositioned to capture a rally. Now look at the countermove from the smart money in the FAI column. FAIs are absorbing that upside, adding over 37,000 long call contracts to their books. They are injecting capital to add another 26,000 stock future contracts. With retail out of the way on the call side, FAIs face minimal upside resistance, positioned to capitalize on breakouts. If we shift the matrix layout to focus entirely on the put side, the primary obstacle to that breakout becomes visible. The pro column exposes a glaring anomaly, the execution of a 3.15 lakh put buying program. They have bought only a fraction of that volume in calls. This is a directional skew, rather than a balanced delta-neutral hedge. This aggressive defensive posture is likely built to protect against external macro drivers, specifically weekend geopolitical risks and the threat of a sudden gap down. Regardless of their motive, holding a bearish position of this magnitude introduces intense friction right at the current price levels. This proprietary put anomaly is the heavy anchor holding the market back, establishing a firm ceiling until those puts are either monetized or expire. To locate where this friction impacts the market, we project the data onto a heat-mapped Nifty option chain, covering the 24,100 to 24,500 strikes. The immediate resistance starts directly at 24,250. This congestion extends to the 24,300 strike, defining the strict upper boundary of the institutional deadlock. But looking further out to the 24,500 strike, the data thins out entirely. The total absence of aggressive call writing at 24,500 indicates that option sellers lack the conviction to bet on a sustained deep market drop. Scanning downward allows us to locate the critical support floor. Overlaying participant data shows retail traders heavily bought puts at 24,150 and 24,200, and the FIIs are the ones who sold those exact same puts to them. By underwriting the risk at these specific strikes, FIIs have deployed massive capital to enforce this pricing floor. This establishes 24,150 as the definitive line of control, the exact threshold separating an institutional bullish defense from a total breakdown. We can translate this option chain geography into a rigid three-tiered architectural model for intraday execution. The central block, spanning from 24,150 to 24,300, is a high-friction neutral zone where FIIs and pros are currently at a standstill. Because price action inside this trench is a function of institutional friction, navigating the deadlock requires fractional position sizing and waiting for 15-minute candle confirmations. The true opportunity lies upward at the breakout threshold of 24,300. A sustained break above 24,300 proves the pro-put resistance has been neutralized. Crossing this threshold triggers the mandate to scale into medium or full position sizing, targeting the open air toward 24,400. Conversely, we must monitor the downside at the 24,150 line of control. A breakdown below 24,150 proves the FII defense has failed, and the proprietary put buyers were correct. Losing that line of control demands an immediate pivot to short delta strategies with increased sizing. Pushing the Nifty index completely out of this highly congested neutral zone requires one final powerful external catalyst. While the IT sector provides baseline support from recent earnings, true breakout momentum requires a surge from the Banknifty index, and the Indian banking sector operates on a strict inverse relationship with global crude oil prices. On this dual-axis chart, we track the critical threshold. Crude oil on the MCX must hold below 68.70. As long as crude stays suppressed, it removes the pressure on banks, allowing Banknifty to attack its own resistance. Banknifty clearing the 58,000 mark provides the necessary beta injection for the broader Nifty index to finally clear the 24,300 proprietary resistance. Tracking institutional strike underwriting provides the execution map, but macroeconomic commodity flows provide the fuel required to drive the breakout.